Greetings, comrades. We've got a 10-mark question here where we've got to record a bunch of additional information points that we have dot pointed here. What we need to note, first of all, are the dates. So go back to the start of the question here. We've commenced operations at the start of June. We're reporting monthly, that's key. We've got a pre-adjusted trial balance 1 month later at the end of June. And we're doing our GJ entries at the 30th of June. So that's going to be our date for all of the entries we're going to have in our GJ. So entry number 1, we've got some advertising down here. 15k plus GST prepaid for 6 months on the 1st of June. Again, what are we required to do? Because this is a pre-adjusted trial balance, there is no advertising expense in our pre-adjusted TB. We've got to do a GJ entry at the end of June to reflect the consumption of part of that prepayment. So in terms of the maths of this, what we need to do is we need to find our prepayment, 15k. We're going to divide that by 6 since it was a 6-month payment and we're trying to work out 1 month. So 15k divided by 6, that's 3,000. That's our consumption. Now, when you are doing a balance day adjustment for prepayment, we don't touch the GST. That full GST was recorded when we paid it on the 1st of June. We don't need to adjust from that. GST doesn't apply accrual basis concepts. So what you're always going to do when you're doing a balance day adjustment for an expense is you're going to debit the expense because it's increasing. The only time it won't be a debit to the expense is if we're doing a correcting entry. So in our GJ, we need to reflect the consumption of the advertising for 1 month. 3,000 we worked out. Don't forget your date, 30th of June. And in terms of our credit entry, well, because prepaid advertising is an asset, it's been partially consumed, so therefore that's a decrease in the asset, so therefore we're going to do that as our corresponding credit entry. Second adjustment, we've got some rent here, 5,500 per month plus GST. It's paid at the end of the month normally, but due to an oversight, the rent for June will be paid next month. So again, dates are critical here. We have to do an adjustment on the 30th of June to record the additional information. We're applying accrual basis concepts, so therefore that 5,500 rent has been consumed. It needs to be recorded. And so therefore a bit of a trap here is usually we prepay rent. But in this case, we're paying it in arrears. So therefore, again, on the same day, we're going to debit our rent expense for 5,500. We are not going to record the GST until we actually make that payment on the 7th of July. We are doing this entry at the 30th of June. So the GST is not applicable here. So instead of crediting a prepaid item like we did for the previous one, we're going to create an account called accrued rent expense. There's a liability here that is created at the end of June because we owe our landlord for that 5,500 consumption. Okay, now we're up to the third one. Got some wages owing here. 2 grand. So again, as I said before, with all BDAs, we always debit the expense. We're applying accrual basis concepts. So therefore, we're going to debit our wage account by 2 grand. And just like the last one, there's a liability that's been created, given we owe our staff money for work completed during the month. So we're going to call this accrued wages for 2k. Nice and easy, that one, I think. Then we get to this statement here, the business has 100% markup. What do we do with that? Nothing. There's no adjustment required. We already know our cost of sales. What we're doing is a bunch of balance day adjustments. So this is just helpful if we have a sales return. Again, at the bottom here, it says record the additional information. What that means in disguise is any balance day adjustments that are necessary. There is no necessity to make an adjustment for the cost of sales. We already know it. We've got our sales revenue. Half of that is our cost of sales. Ignore. Now, this next one, number 4, really screams out to me the value of reading time, because there's a bunch of dates here, there's a bunch of calculations that need to be made. So therefore, in order to kind of not get caught up in a trap like this question, this dot point number 4, use your 15 minutes reading time and use a mental highlighter to flag key dates. So again, just a reminder, in terms of this question, this is a pre-adjusted trial balance at the end of June. We started our business on the 1st, and we've made a 12-month term deposit halfway through the month, earning 3% per annum. The interest is payable annually at the end of the year. Now, what that means is we're not going to receive any interest prior to balance day, which is the 30th of June. But because the accrual basis applies, we need to record the revenue earned. Because when you have a term deposit, you're putting money in the bank, and in return, the bank pays you interest. So therefore, this isn't the odd one out because we're actually generating revenue, but we need to do a bit of maths here. So we've got our term deposit here, 240k. We're going to multiply that by our rate, 3%, to work out our interest per annum. On your calculator, you should get 7,200. Then, because we're doing this 15 days after the term deposit, we need to go a bit further. So we're going to divide this by 12 to work out that we get 600 interest per month. And again, we need to be very careful with our dates here. We started the term deposit on the 15th. So therefore, we've actually only earned half a month's interest. So we're just going to divide that by 2, and that'll trigger a $300 interest revenue that we've earned. So our credit entry here will be interest revenue. It is important that we identify it as interest revenue so we don't get confused with interest expense. And we're going to create an asset account called accrued interest revenue. It's an asset because it's going to result in a future economic benefit when we receive that money at the end of December. Okay, final one, number 5. We've got some vehicles that we purchased start of June when we started business operations. So if we go up to our TB, they're worth 180k, and we depreciate them at 20% using the RB method. There is no ACDEP here because it's a new business, and so therefore we haven't allocated any depreciation prior to that. So step 1 here is let's work out our annual depreciation using our formula, 20%. So we're just going to multiply that figure by 0.2. That's going to give us 36k. That's a per annum figure. And we had the vehicles for exactly a month. So therefore, we're going to simply divide that by 12, and that's going to give us $3,000 depreciation. So therefore, in terms of our GJ entry, we always debit the expense, depreciation. You must identify the asset, even if there's only one NCA that we're claiming depreciation on. Otherwise, you'll lose a mark. and we do a credit entry to our ACDEP on the vehicle.